can go ahead and start diving into things. First off, I want to thank you all for being here, and thank you to those of you who have tuned in since the beginning of the series. We really appreciate your continued interest and attendance. For those of you who do not know me, I'm Alana Bell, Residential Buildings Coordinator at NASEO. Just a light reminder before we dig into things today. As you may have noticed at the top of the call, a notification that we are recording this webinar, and it will be posted to the NASEO YouTube channel. So at the end of the series, we will post all of the links for the recorded webinars for reference on the NASEO residential task page or task force page. So stay tuned for that. We also have time reserved at the end of the call for Q&A. So as we hear from our panelists today, feel free to drop questions in the chat or raise your hand, and we'll return to those at the end of their presentations. And let me just go to the next slide here. So just a reminder, this is a part of a larger call series on affordability and multifamily. So we've already had 4 calls, each of those recorded, posted to the YouTube channel, as I mentioned before. Today's on funding and financing multifamily buildings. And then our final call will take place on November 19th on behavior change and long-term engagement. So that call will feature state energy office perspectives and also subject matter expert perspectives on how to engage multifamily residents to change behaviors and achieve long-term energy savings goals. So yeah, and that'll be the wrap of the series, but also just a reminder, this is part of a larger initiative that NASEO is taking on to support you all state energy offices and your multifamily initiatives. So don't hesitate to reach out to either Maddie or I if you would like NASEO support on any of the work that you're doing. So I think that's all on my end. So without further ado, I'll pass things over to our moderator for this call, Aaron. Aaron, the floor is all yours.
All right, thanks, Alana. Hello, everyone. I'm Aaron Miller. I'm the Energy Planning and Resources Supervisor with the Nebraska Department of Water, Energy, and Environment. And I'm excited to help moderate today's discussion on multifamily funding and financing. And we've really got a great lineup today. I'll start with a brief overview of Nebraska's Dollar and Energy Savings Loan Program, including how we've supported multifamily projects. Then we'll hear from Dana Adams, State Policy Project Manager with the U.S. Green Building Council. Then Bennett Hilly, Vice President of Strategy and Credit Risk with Community Preservation Corporation, Climate Capital. And then finally, Matthew Brown, Co-Chair and Managing Member, along with Jensen Hanwork, Senior Director for Program Development with the National Energy Improvement Fund. So these conversations are a great opportunity for state energy offices to think creatively about how to leverage existing financial tools, loans, tax credits, partnerships to reach multifamily housing more effectively. So I'll start with a quick overview of our Dollar and Energy Savings Loan Program, and I'll call it DESL for short. And then I'll touch on how it's been used for multifamily properties and some of the challenges we continue to see. So Nebraska's DESL program is one of the longest running financial programs, energy efficiency financing programs in the country. It's a revolving loan fund that was created in the 1990s that uses a blend of state and private capital to finance energy efficiency and renewable energy improvements for residential, commercial, agricultural, and multifamily and public facilities. So how it works, so what the state does is we provide a low cost, which is really zero cost capital, to more than 200 local lending partners, which include banks, credit unions, savings and loan institutions all across Nebraska. And they are the ones that issue the loans to customers for qualified projects, and the state participates in the loan that the borrowers pay as little as 1 to 3.5% of interest. To date, the program has financed tens of thousands of projects, totaling well over 400 million statewide. We finance everything from insulation to HVAC upgrades to LED lighting, irrigation efficiency, and renewable systems like solar, wind have all been supported through the structure. That said, about 90% of our loans go to single-family residential projects, so we don't actually see a large number of multifamily applications. even though we know that the sector could benefit greatly from the program. But when it comes to multifamily housing, we've seen both successes and challenges. The DSL program has funded a range of multifamily retrofits, include lighting, HVAC, and envelope improvements. And really a key benefit to our model is that building owners can make these investments at a low interest rate while tenants experience the utility savings. So it's kind of a win for both sides. Of course, like the financing structure and all that stuff still requires good communication between owners and tenants. But it's just, I think it's a great example of how efficiency investments can align interests when they're designed thoughtfully. We also coordinate closely with Nebraska's Weatherization Assistance Program, which serves income qualified households. Our programs often cross-refer projects. So for example, when a multifamily building exceeds weatherization limits or needs deeper upgrades, we look at DSL or utility incentives to fill the gaps. One of the really big persistent challenges we come across is the limited availability of contractors and technical expertise for larger or older multifamily buildings, especially in smaller communities and rural areas. Many of those projects need like custom audits, benchmarking, or tenant engagement that go beyond single family approach. Kind of looking forward, we do want to explore ways to get better at integrating energy benchmarking, data sharing, affordable housing finance tools, including coordinating with our housing finance agencies and tax credit programs to make multifamily projects more feasible. But really our ultimate goal is just to make energy improvements accessible to all Nebraskans, whether they live in single family or multifamily buildings, ensure those investments improve both comfort and affordability for tenants. So with that kind of overview, I'll hand it off to our next speaker, Dana Adams.
Hi, thank you. Give me one moment to get my slides up there for you. Okay. All right. Thank you, everyone. So I will be speaking on LIHTC and green building certifications. For those that might not know, the U.S. Green Building Council, USGBC, is a nonprofit 501c3 member-driven organization dedicated to decarbonizing the built environment to create equitable, healthy, and environmentally friendly communities around the world. And it is the propagator of the LEED building rating system, which is the widest green building rating system used in the world. And many of you might be working or passing by, driving through, or visiting LEED certified buildings in your communities, just as a fun little plug. And I'm the state policy project manager, so I work for USGBC's advocacy and policy team, and we work on a variety of policies that do support green building in general, LEED, as well as affordable housing, because we are committed to making sure that all communities can benefit from sustainability. So like I mentioned, our mission is to create communities that are designed, built, operated, and enable environmentally and socially responsible and prosperous environments that improve the quality of life. As we know, we spend about 90% of our time indoors. And so that means that things like indoor air quality, VOCs, volatile organic compounds, the building materials themselves, the heating and cooling, water usage, waste, all factors into the health of the buildings that we're in, but also that building's impact on the climate, the environment, and essentially our communities as well. And so buildings are also responsible for about 40% of CO2 emissions, which climate and emissions reduction is one of the biggest driving principles of USGBC's mission. And so efforts to decarbonize the built environment is not equally distributed across communities. there is really a cost barrier for many communities and families trying to either reduce their carbon footprint, reduce their spending on utilities, access to energy efficiency, and other affordability measures. And so one way that that can be remedied is through our work with the Low-Income Housing Tax Credit Program, LIHTC, which is a federal credit program that was created in the late 80s to incent the investment and development of affordable housing. And LIHTC, to this day, is one of the most successful public-private partnerships in the US. It has, over the course of the program, led to over 2 million units of affordable housing. And about every year, there's 10 billion that goes to states and LIHTC allocating funding agencies to support the development of low-income housing. So LIHTC is, while it's created in a program that is federal, it's administered by states, usually a housing agency, which determines how the credits in the program are allocated. And these credits are important because they are what developers, project owners compete for in order to get a tax credit on their tax liability. So, and there's only a limited amount per year. So it's highly competitive every award cycle. And usually those cycles can last for 15 years, but there are some that buildings that are in the cycle up to 30 years. And so how states determine where those credits go is through a qualified allocation plan. And so it's a determining of the required conditions for projects to qualify and also those QAPs also include additional conditions, which are competitive points to drive project developers to do things such as adopt energy efficiency and green building policies or practices within their projects. So some states do use this as a lead by example policy so that they are still driving down their carbon footprint while also allowing for equitability in access to clean and sustainable, there we go, we got there, living. And so this map is the current map of the status of green building requirements within the QAP plans across the states. And so some states, as you can see, we have about 5 categories here. Some states are they have no energy efficiency requirements, which is only one, Alabama, but many of them in this bell curve have optional points that for adopting or getting your affordable housing projects certified with LEED or a comparative green building certification program. And so that's about 20 states. And then we have states such as Washington, Florida, Georgia, for example, that require projects that are receiving LIHTC funding or LIHTC credits to be LEED or comparatively certified. And then there are a lot of states that kind of fall somewhere in there where they do have some energy efficiency provisions, such as requiring the use of Energy Star appliances or having certain air quality controls, among other requirements. And then there's a small percentage of states that really go above and beyond, which they require a green certification for their LIHTC projects, but they also include optional points for projects that seek net zero certification as well. And so this map is also really developed in the past 20 years, even actually within the last year when I was updating this map last night, you had several states that moved up from having just a few requirements to requiring optional points, competitive points to drive developers towards greener choices, or just requiring them, which is also good to see that these options are becoming available to more communities in more states. So why does LEED or green certification matter when it comes to LIHTC? And so why having a green certification or such as LEED in a LIHTC program means that it is, for one, it's a ensuring certainty and transparency that the claims that these project developers are making are being followed through so that the efficiency claims, resiliency claims, sustainability claims are true and verifiable, and they're verified by third parties, not by the company that is propagating that standard. So it's very transparent and easy. And so, for example, in Washington, D.C., a study of third-party certified buildings that were renovated as a part of affordable housing projects. They had substantial savings in energy and water costs, which were 16% and 54% respectively. And energy and water for low-income individuals are some of the highest utilities that they pay. And utility costs between low income and higher income individuals are unequal. The lower your income, the more you tend to pay in your utilities, largely because of where you live. And so this demonstrates that there is a value for these third-party certification standards, and that it actually has a tangible impact, and that impact can be felt by people who really need it. And another addition is that LEED certifies LEED homes, and over 50% of homes that are certified under LEED are affordable housing units as well. So one of the benefits of LEED, of course, is also that it's consensus driven and developed by experts and renewed on a 5-year cycle as of this year with the release of LEED v5. And so what this also means is that the standard is continually updating, continually growing, continually benefiting from the most up-to-date understanding in energy efficiency, sustainability sciences. And that also allows state agencies that incorporate LEED or other green certification standards into their LIHTC programs the ability to leverage that expertise at no cost to taxpayers. So it's not a state-developed program or a state-administered program that standard that they're using. It is an independent third-party standard that does not cost taxpayers. And one of the other benefits also, as well as requiring or encouraging the use of green standards, is also the ability for project developers or LIHTC programs and state programs to layer these with other green or sustainable building tax credits that are out there. In the past, that was several of the IRA tax credits, and now currently under the OBBA, there are a few others that can be now layered with LIHTC credits as well. And currently, as things stand, the availability of these credits and funds are kind of fluctuating given our current environment, but the opportunity is there, and the opportunity will likely be there ultimately in the long term after the cycle passes. And finally, what can energy offices do to help housing agencies and LIHTC programs achieve both their mission as well as equitable sustainability? And that's also working with housing agencies to strengthen those energy efficiency requirements within their QAPs and helping serve as an expert, either by taking models that are being used in other programs across in the state that can then be adopted into the housing agency's modeling, or supporting the use of comprehensive third-party green building certification standards. And then also energy offices can coordinate with housing agencies to provide, of course, technical assistance to the developers and owners as well, who are trying to take advantage of these opportunities to create energy efficient, sustainable LIHTC housing. And then, of course, as I mentioned, the funding for certain credits and federal programs being in flux is that's one thing that energy offices can also do is look for other opportunities to fill funding gaps, get creative, or consider other state programs, federal programs, or even programs that are offered through state or local utilities that can support housing agencies and light tech projects to also defray the costs of development and support their sustainability. And of course, one thing that also is notable about LIHTC requirements is that if we refer back to the map that I showed a couple slides ago, we see a particular geographic divide among where your more stringent EE requirements are in LIHTC and where they are looser. And this really indicates that policymakers and the environment, the political environment for which the state is in, is really going to affect how your LIHTC program develops. And so one thing that energy offices can also do is guide policymakers to consider how they can support EE and resiliency and third-party certification as a term of for affordable housing and in terms of cost reduction for both the state tenants and the communities that these projects are located in. And with that, I will pass it off to Aaron.
All right. Thank you, Dana. Very good. All right. Up next, we've got Bennett Hilly with CPC Climate Capital.
Great. Thanks, Aaron. Alana's going to share my slides, I think. She and I were just chatting, but great to see everybody today. One, I just want to thank you all for being here and for NASEO and everybody for focusing on this topic, right? It's near and dear to my heart. I'm actually worked in housing for a very long time, most recently in multifamily and HUD, where I met a lot of the NASEO team, and just really excited to be here, and thank you for this opportunity. So CPC and CPC Climate Capital. So CPC Climate Capital is actually a subsidiary of a much larger nonprofit CDFI. If you want to go to the next slide. So CPC, the Community Preservation Corporation, has existed for over 50 years. We're one of the largest CDFIs or nonprofit lenders in the country, focusing exclusively on multifamily housing. Another really unique aspect of us is we actually have construction lending arm, we have a mortgage lending company, we do housing equity investing. We service a very large portfolio of multifamily housing, and for about 20 years, we focused on high performance energy efficiency lending within our portfolio. We started with a focus in New York City and New York State, but actually CPC now has a nationwide presence, and my team specifically is working nationwide. Actually, 85% of the construction loans our organization closed last year met our kind of high performance building criteria. And so just the next few slides are a few of the examples of the programs that CPC has worked on. Most recently, we've worked as one of the CDF awardees through the Green Bank of New York to administer a kind of subordinate financing program where we put subordinate financing behind several first mortgages that CPC was actually originating as well, so that these buildings would increase their scope of work to include more energy efficiency, electrification, and sustainable upgrades. These were all focused on affordable housing because that is what CPC does, but this is also the focus of the CDF program through the Green Bank. Next program we have been working on and we're currently administering this on behalf of New York State, is the Climate Friendly Homes Program. This is focused on deep electrification or partial electrification in existing multifamily buildings between 5 units and 150 units in New York State. These units are all either naturally occurring affordable housing or kind of regulated affordable housing. So we're actually fully subscribed to this program, but we've been getting a lot of great data and learnings through it as well. And then next and final quick example, this is why I and others were brought on board, was to actually lead a program on behalf of a US EPA award of about $2 billion. That money is currently frozen, but it's still there, and we're hoping at some point will be accessible again. We were going to also focus on subordinate lending behind first mortgages for multifamily recapitalizations that we're going deeper and in this case decarbonizing. So, so we've been in this space for a long time. Next slide. We can want to make sure I get to and we closed a couple deals under that grant program before we couldn't access the funds. So this is just one of those deals that we did. And then I just want to make sure I get to the meat of the presentation because so what are we trying to do, right? We're trying to make it so that going forward, developers, owners of multifamily housing, even multifamily lenders are doing this work and thinking about energy efficiency and resiliency upgrades just as part of the regular development process, right? When you touch your building and you recapitalize, you are thinking of these upgrades just as part of your scope of work. So our kind of long-term goal is to work ourselves out of the business of providing subordinate loans for this purpose because owners and lenders will start to think of this work as making economic sense, right? We all know that it does. It lowers energy costs, adds to building value, but our goal is to make it so that this becomes automatic and second nature. That's going to take a while, and it's going to take all of us continuing to work on these programs for many years, but we will get there. I'm going to be confident in that. So next up, one thing that I do want to make sure, especially as a houser on this call, is we talk about affordable housing all the time, and no one always talks about exactly what does that mean. And there are actually a lot of different types of affordable housing, and it's really important to make that distinction in your communities, in our communities. What affordable housing are we trying to serve? Because if you're not thinking about the limitations or how those programs are structured, it's going to be hard to design programs that are most effective in reaching the multifamily owners and developers you're trying to reach as a state energy office. I pulled this together in the last couple days just because I wasn't actually sure. I had it in my mind, but I wasn't sure it existed. It may not be absolutely perfect, but I did have several colleagues and friends vet it for me. This will take forever to go through the slide, but I did want to point out that there's public housing, there's HUD assisted or USDA assisted housing that has rental assistance. There's LIHTC funding, which Dana just covered. That can go along with housing that also has rental assistance contracts, but it's actually a form of equity, right, going into a recapitalization. There's also workforce and middle income housing, and then there's naturally occurring housing. So each of these is very important to understand what in your community are you striving to target, and it may mean building out multiple programs because you can't really reach recapitalizations in the same way that you can reach properties mid-cycle between big mortgage loans. So next up. So just wanted to throw out a few kind of key practices or best practices recommendations for energy programs depending on which type of housing you're trying to reach in your community. These are just mine and based on some conversations with colleagues who've been doing this work for a long time, but these are some high-level recommendations depending on which type of housing you're trying to reach. Next slide. We can always go back over this. I just want to make sure I get to some other things. So why is preserving or developing multifamily housing so difficult and expensive, right? I'm sure many of you know this, but I just wanted to make sure I'm going over the quick basics here. Next slide. Okay, so market rate housing gets built because probably like each of our forced mortgages, if you own a home, you can get a mortgage loan for a certain amount based on your income. Well, here for an owner, it's based on the rents you can generate after you take out your operational costs. And then you make the rest up with equity. Well, that's different for affordable housing, especially when I'm talking about affordable in a lot of these slides, it's more about those that are limited in terms of the amount of rent they can achieve. And so I'm talking mostly LIHTC properties as well as deeply subsidized, like regulated affordable housing here. But they have a funding gap, right? Because the affordable rents they can attract are not enough to really generate enough money to service the kind of debt they could if they had a market rate rents, right? So you've got this very small amount of debt that you can attract, and then you need to bring equity to the table. A lot of these are nonprofit developers. They're not always able to bring a ton of equity. So as Dana covered with the LIHTC program, most of the equity you're going to see is LIHTC in these deals, so generated through that program. So the slice that developers are bringing is actually quite small versus LIHTC is about 20 to 30%. Okay, so next slide. So how do we deal with this giant funding gap between your rents and then get to the place where you can actually redevelop or renovate a building or build a brand new affordable building? You've got to have subsidy, right? And that's where state energy offices and other state and local funds become so incredibly important. It's filling this gap. and it's filling the gap either as part of the construction budget, right, and coming in as kind of a soft loan or other source in the capital stack, or the other option is through rental assistance, right, which that is a very limited resource. That's those number of rental assistance properties out there hasn't changed since like the 1970s and 80s. So when we're thinking especially about developing new housing, most of it is coming from the fact that there's subsidy for the construction process. So next up, did want to highlight before I left that for anybody who wants to go deeper, which I highly recommend, there's a great podcast that I linked to on that slide. Just 20 minutes walks you through the basics of like how affordable housing is financed. It's really, really helpful. It probably taught me more than I knew for about 6 of my years at HUD. So these units are but actually what ends up happening a lot of the time is because each of those subsidy resources, especially on the construction side, are government resources, they come with a lot of complication, a lot of administrative cost. A lot of those are really good. We have good reasons for those. For example, the QAPs pushing owners to build greener in order to get the LIHTCs that are highly competitive. So I'm not saying this in any negative way, but it starts to get more expensive. And every new resource you put from a new government body or put in a new player in the deal, it makes the project more and more expensive. So you've got a kind of issue there in terms of our goal is to make it easier and more inexpensive to build affordable housing so we can do more of it. But yet, by having so many different resources going in, we're making it more expensive. So this is just an example from my local community in DC, where Washington Post actually featured some affordable housing. It was a deep renovation. Each unit for the affordable housing development was $1.2 million per unit to build, versus the market rate housing that was being built very similarly across the street was $350K a unit, right? So I just want to highlight it makes sense why it's more expensive sometimes than market rate, but we are, and including as government partners, part of driving up those costs. Next slide. So where do we think about how do we streamline? How do we make sure that any new resource going into these deals is going to be an overall benefit to them and help them, get built or get renovated in our community? So these are some very high level recommendations, and a lot of state energy offices are doing a great job of this and starting to move towards thinking through some of these when designing programs. And I will say with a caveat, I know that DOE and other federal agencies have kind of tied a lot of hands here in what you are able to do and design because of sometimes I will even say, having worked with DOE folks, them not always understanding how multifamily housing is financed themselves has added complication, right? So I know that some of these things are very hard to achieve, especially when using resources that already limit your ability to be flexible. So what should we do? We should think about, number one, when trying to serve LIHTC properties or Section 8 multifamily properties, and Dana hit on this, LIHTC properties only really get refinanced every 15 to 20 years after the compliance period is done. So Lindsay from our team is on the call. What's key here, and she described it this way, it's like a train is passing by. If we're trying to preserve this affordable housing, there's only one opportunity to really touch it in every 15 to 20 years. So if we're missing that opportunity to make sure that energy efficiency or electrification or whatever your state goals are getting achieved in that project, we will miss it. And then it will be what it is for the next 15 to 20 years. So the extent possible that you all are trying to target kind of really deep upgrades or really touch these LIHTC and Section 8 multifamily properties, recapitalization is the moment to do this, right? So leverage refinancing events and make sure your programs are designed so they work for those. Align with your existing affordable housing capital channels, right? Many of you are already working with your state HFAs, but one key thing is as much as we can create more of a one-stop shop where people are going to one government agency to get resources, that can really streamline and help, right? And reduce the kind of the additional administrative requirements and compliance requirements if all funding is kind of flowing through the entity that understands housing in particular. I know that can be really hard and challenging and not always possible, but it's in here as a recommendation. Third big one, offer money as soft loans. grants do not work well for these properties most of the time. Not only could be taxable events, but for the light tech developments, which is really how most multifamily affordable is getting renovated or built these days, it actually hurts them to have grants. They will reduce the light tech basis. So we can go over that if folks have questions, and many of you probably know that already. But please give owners the option of getting the money as soft loans. Aaron is probably shaking his head because that's probably why they structured their program that way in Nebraska. Next up, and I'm almost done with my best practices. When you're looking at recapitalization projects, here's some other things to just keep in mind. One, try as much as you can to structure programs to reflect how multifamily construction works. I know this can be tough, but you're talking about a larger scope of work that's happening, right? Influenced by whether it's a physical needs assessment or other kind of lender agency requirements. But a general contractor is brought on to do the entire scope of work. Sometimes when there is a separate resource, where there has to be a state selected contractor or the contractor has to be paid by the state and it can't be the general contractor, delays happen. You've got a lot more administration you have to think through, and it can drive up costs for these projects. So just be thoughtful to the extent possible to align how programs work with multifamily construction practices. Where you can, allow for administrative flexibility so that owners or developers who are doing, let's say, a third-party assessment for another office can use it for your program, right? They don't have to do something to check your box when they've already done something that meets what your actual need is through another department or lender. Think about multifamily timelines. Multifamily recapitalizations takes 2 to 4 years to line everything up. Everything has to close at the same time. At least in my experience, a lot of state energy programs are really meant, and some of this is again back to DOE and how they've structured programs, works for like a very quick direct install or contractor reimbursement, and really doesn't work well with a 2 to 4 year timeline that it takes for a large scale multifamily affordable transaction to recapitalize. And then as much as possible, where you have flexibility, providing early stage financial support for owners who may not be able to do the kind of energy audits or other expanded physical needs assessments that you require. Figure out how to support them with those costs because they won't be able to access that capital as easily, especially prior to closing. So those pre-development costs are the hardest to pay for. And then last slide really about recommendations is, as much as you all, if you're trying to serve properties mid-cycle, right, and not aligned with recapitalizations, because those would really have to be 2 separate programs, is to think about how do you reach mid-cycle projects well, and how do you design your program so you're figuring out which properties to target so that you make sure that your programs are subscribed. So one is for mid-cycle. That works really well for a certain subset of multifamily affordable owners, in particular public housing authorities and owners of like Section 202 and 811, that's housing for the elderly and housing for persons with disabilities. That works really well for them. They love grants. They can do work mid-cycle because they actually can't attract debt for their renovation. So it would be a perfect fit for them. So figure out how to target those properties in your communities. 2, don't expect that owners can bring money to the table. When we're talking especially about the deeply subsidized versus like naturally occurring, these owners are already operating on very thin margins. They're going to bring sweat equity to the deal, but to expect them to bring any more matching funds is going to be very hard for them, especially mid-cycle, because it can't take out a loan mid-cycle. So it just doesn't work for them to bring money to the table necessarily. Third, maybe odd, and Alana and others, Aaron told me I'm almost done if I'm running out of time, is don't require tenant bill savings, or at least don't require it across the board. Reason I say this, tenants can't actually benefit from bill savings for a lot of the properties I'm talking about. It's not allowed. It's actually the federal agency that provides the rental assistance that benefits, or the PHA who benefits. But if they're benefiting, they're actually going to use that money and then renovate or maintain their other housing, right? So it's not that I don't want residents to benefit and build wealth. It's just not possible. So keep that in mind when designing programs so that's not always required across the board. Maybe it's required for your naturally occurring affordable, but for your buildings with rental assistance, it's not. And also, rents don't go up for those households based on um, utilities, right? But their total tenant payment is always based on the rent, the portion of rent they pay, and utilities. It never, like, it stays constant. It's very complicated. Happy to explain it offline. And then last two are things that Aaron has already hit on in terms of how do you build up a contractor base that works on multifamily? That's always difficult, but needs to be ready when the multifamily properties are ready to go. And back to always continuing to provide technical assistance and financial support. So I think that is almost it. Just a quick note for those on the call. Our organization is continuing to try to do the work that we were funded for through the EPA grant that I mentioned. There are 5 of us still working very hard on continuing to build this infrastructure to support the work that you all are doing and making sure that we are really serving affordable housing and getting these energy efficiency and resiliency upgrades that they need. So we are happy to have conversations if there are ways that our nonprofit and us as a lender can help support your programs. We want to make sure you know we are here to help. We will actually be doing some pilot transactions, but are continuing to look for partners and capital to keep doing this good work. So thank you again for all the time today, and look forward to hearing the rest of the presentations.
All right. Thank you, Bennett. Thank you very much. Appreciate it. Just as a reminder, at the end, we'll move into a Q&A. So if you do have questions, go ahead and put those in the chat, or you can also use the raise your hand tool. But up next, we've got Matthew Brown and Jensen Handwork with the National Energy Improvement Fund.
Very good. Thanks, Aaron. And compliments to NASEO on putting together a really good kind of set of presentations that I think are giving the folks on this webinar a pretty nice kind of diversity of experiences and information. So when Bennett was talking, she was referring it to different categories of multifamily properties and therefore multifamily financing. And where we live is not so much, not at all, really, in the affordable housing world. We live in the what I'm going to call that naturally occurring or non. Sometimes I'll say small A affordable or large A affordable. The small A affordable being the stuff that isn't getting all the complex subsidies and wonderful stuff that I'm sure Bennett deals with every single day. So the so just a quick note on who we are, National Energy Improvement Fund. We are a lender. We actually are a lender that we do consumer lending and commercial lending, and multifamily falls under our commercial lending world. But we're a little bit unusual, or maybe very unusual, in that we really only lend for energy efficiency and electrification. That is all we do. So that means that what we do is we end up working a lot with utilities, working a lot with states, working a lot with green banks to really try to put together financing packages that are going to be attractive to both the contractors who offer the installations as well as the customers for these types of projects. We offer either an unsecured or an equipment secured loan. And what that means is that first and foremost, we are not a mortgage lender. We do not take any type of collateral interest in the property itself. Everything we do is either unsecured or equipment secured. So basically, we'll take an interest in the actual equipment, whether it's a solar panel or lighting or HVAC that we are actually installing. So that's kind of the world in which that we inhabit there. And the other thing I think that's helpful, just kind of at the outset, one of the things that we've found found to be a really useful thing to specialize in is the fact that we are able to combine different sources of capital. And so what I mean by that is that if, for instance, and this kind of goes to a bit of a recommendation for state energy offices to think about, if a state energy office has a revolving loan fund that is what I kind of generally tend to talk about as flexible capital. If a state energy office has flexible capital that may be limited in dollar amounts, which of course it always is, but we have the ability to bring in private capital, whether that's capital from banks that we work with, or credit unions that we work with, or other investors. So we have the ability to combine different sources of capital in order to be able to create a much more attractive financial offering to a customer, and one that can be very suited to a particular market. So that's kind of one of the things we end up doing a lot is talking to different types of investors, whether they be private or others, putting together those capital sources in order to be able to assemble a very attractive financial package. So therefore, we end up working a lot with state energy offices, revolving loan funds that they may have, some of the green banks around the country, structuring other types of credit enhancements. A couple of people have mentioned subordinate capital structures, for instance, where that's this type of structure we use when we take energy office capital, combine it with and leverage it with private capital. So couple things that before we move to Jensen, who's going to give a couple of very specific examples of projects that we've worked with. Some of the things that we end up looking at very closely when we're looking at these naturally occurring multifamily properties, and this is just something to be aware of in the underwriting. And these are things that really we end up collecting data on and analyzing and reviewing. Occupancy rates, for example. We need to make sure that there's a consistent, either growing or stable occupancy rate for that particular property when we are underwriting that property. Reserves. So does that property have the cash reserves to truly indicate that that property and that property is being managed appropriately from a financial standpoint, that it has the ability to handle expected or unexpected types of investments that are going to be required for simple maintenance of that property. So having adequate reserves is an important piece here. Corporate structure, we often find this is one of the more challenging things, is very often when we are working with and underwriting a property, we end up finding that property might be owned by a very specific LLC or limited liability corporation that really only owns that single property. There can be very often very little credit that's associated with that property, the individual property that we are reviewing. So we often run across issues of how do we actually review and underwrite a property that in and of itself probably doesn't have very good quality credit. One of the things that I think Jensen's going to talk about a little bit is even issues of identifying the proper decision maker. It's not always that easy to do so. And one of the things that we found as we are doing the underwriting and working with property owners is actually finding that decision maker, making sure we are able to work with that decision maker appropriately. And finally, this is kind of in some cases, this turns out to be more important than others, but not only finding the proper decision makers, not only finding the way that particular multifamily property can make decisions, but then one of the decisions that we very often find is required and people have to take a look at is, can there be a special assessment or some type of assessment to cover some type of increase in expenses as a result of the debt that would be incurred. So these are the kinds of things that we review, the kinds of things that we end up asking when we are looking at multifamily properties. Jensen and I thought it would be helpful to have a couple of examples of specific cases where we have financed these kinds of properties and the kind of experience that we've had. So I'll turn it over to Jensen from here.
Great. Thank you, Matthew, and thank you to NASEO, Alana, and everyone else for having us on today, and thank you to the other panelists for great presentations. So I was very excited actually to be asked to come in and speak to a couple of the examples of multifamily projects that we financed. Because when I reflect on the numerous projects that we've helped finance, that I've helped finance over my career at NEIF, from small businesses to nonprofits, government buildings, and so on. A couple of the multifamily examples that pop into my head are actually that we've helped facilitate are some of the projects that I find myself most proud of. And the reason being is I really relate to what Bennett said, which is that property owners and these decision makers bring a lot of sweat equity into play. And so, for various reasons that Matthew has talked about and our other panelists have discussed, there are variables to multifamily financing that make these projects somewhat more difficult to underwrite. However, when you meet these property owners and decision makers and contractors where they are, and when you are able to achieve these wins to get these projects financed, they turn out to be good stories. You're making a difference in people's lives, right? And so I'm going to actually share my screen and bring up a couple slides just to speak to a couple of these examples of projects that we financed. Both of them are from 2022. And so just to set the stage, right, to go back into that time, right, coming out of the pandemic, the industry was facing, especially in the commercial financing world and commercial equipment world, was facing extreme equipment shortages and delays. And that underpinned both of these projects. And so the first was on Shore Road, New York City. And this was an interesting project. This building is an older building in New York, and their HVAC system was actively failing. So it was not an all-out failure yet, but fall and winter weather were right around the corner. And they were looking at the possibility of having to rent an HVAC system until they figured out what to do from a financing and equipment standpoint. Going back to what Aaron said at the beginning of the presentation, we had the privilege of working with a contractor, one of our NEIF approved contractors, New Wave. It was a very sophisticated, well-equipped contractor to be able to handle this type of project, and they were able to step in quickly and provide this building a good sense of what they're going to need to do, provide them a scope of work that had them looking down at a $750,000 HVAC installation. And although we were working with a building that had a healthy reserve, we were a well-organized board and HOA, and we were working with them, speed and time was very much at the forefront of this conversation. Not only with the weather coming in, but the fact that equipment delays were causing the contractor to have some urgency to reserve their equipment quickly, as there were only one or two available units in warehouses nearby. Otherwise, it would have caused an additional 6 to 9 month delay. So fortunately, a good story here. We were able to step in, acquire a number of the elements that Matthew mentioned, from occupancy rate to financials to information about their reserves, and secure financing for them quickly for that $750,000 system, and actually arrange pre-funding for their contractor, which is so often overlooked, but a massively important element when we're thinking about financing these large projects, is making sure that we're supporting contractor cash flow so that they're able to reserve the equipment. In this case, absolutely critical, so they could reserve the equipment and then install it shortly thereafter. And another nice piece of the story is that just remember that when we're working with projects in large buildings, nothing ever goes completely as planned. This one, as many projects do, had a change order. Although it was small here, only an additional $20,000 of electrical work that was discovered throughout the installation. We were able to layer that back into the financing and actually approve them for the $770,000 loan at the end of the day. And the second project that I want to bring up is a little bit different. But this one is a little bit farther south along the coast in Ocean City, New Jersey, also in 2022. This building, very interesting, it was the oldest multifamily building in Ocean City, New Jersey. And they came to us again in somewhat of a panic to figure out how can we arrange a financing solution to get this project moving forward. Although they were not in the position of an emergency replacement or all-out system failure, the system was nearing the end of its life. And they wanted to take advantage of some utility rebates and financing programs that were available in New Jersey. Unfortunately, they were declined financing through their utility for that utility's on-bill financing program. And so the contractor, CMC Energy Services, who we work with quite a bit throughout the Northeast, came to us hoping that we could put together a solution to get this project across the finish line. And here it was very much a story of sometimes in underwriting, it takes a good story to get these projects across the finish line. This building had very tight financials, very little reserves. However, we went to our capital sources and told a good story. Ultimately, all the building was looking to do was finance about $85,000 when considering that the total project cost was $364,000, just a small portion. And the reason they were able to finance that smaller amount was because about 75% of that project was being covered by a utility rebate. And so I made sure to include that in my story, as well as the fact that the estimated energy savings, although this is not required in the loans that we underwrite, it can be a valuable piece of the equation. And here, the building was estimated to save about $15,000 a year. And so, wanted to tell that good story to the underwriters that even though they have limited reserves, the estimated energy savings were going to pay for or help pay for that added debt service over the 7-year loan term. And we worked with the volunteer treasurer in this case, and we're able to get this project across the finish line. But yeah, so those are my 2 examples. I appreciate the time to share, and I think turning it back to Aaron from here.
Great. Well, thank you, Matthew. Thank you, Jensen. Thanks to everybody. Those are excellent presentations. We really appreciate it, and probably could take another hour to talk about more of the multifamily stuff. So I think we have maybe a couple minutes for questions. So I've got one here in the chat. If a utility bill savings and subsidized housing can't lead to benefits to the building owner, what are some unique strategies you've seen recently that can get you over the split incentive challenge with affordable housing owners investing in energy efficiency upgrades?
I wish I had a good answer. I don't know if anybody else does. I worked a lot on split incentive my last year at HUD and trying to think through how to solve that. I don't know of that many good models, which is why I think, at least hopefully everybody took this away. Like you can't really require, it's why a lot of owners won't do this work, right? They're not going to see the benefit. And we're creating a lot of times these programs that require them to share the benefit with residents, but the residents it doesn't actually always benefit them either. In the deeply subsidized affordable, I want to always make that distinction. So I wish hopefully someone else has one.
I wish I could say we've got a good solution. But it is that split incentive is always a big barrier. And kind of in our day to day, we honestly we have not cracked that nut. I wish I could say otherwise.
But I'm happy to brainstorm and get a coffee or a drink with anybody who ever wants to talk about it, because I would love for us to find some ways to do that.
Thank you. All right. Actually, I don't see any other questions in the chat, and we're about at time too, so that's almost perfect. So I'll shift it over to Alana to close us out.
Thank you so much, Aaron, and thank you to all of our panelists for your wonderful presentations today. I think today served as a great 101 deep dive into the many different options that exist for multifamily funding and financing. So thank you all. And just before we go, a quick reminder that our next call in the series and our final call in the series will take place on November 19th from 1 to 2 p.m. Eastern. So we hope to see you all there. Thank you.
Thank you all.